Good morning and welcome to Options Brew TV. I'm your host, Lex, and we've got another wild market. Interest rates continue to go higher, 50 basis points as expected. We're going to break it down, among other things, on the show, so stay tuned. Oh my God. Look who it is. Welcome, boys. How are you?
I can't imagine what the cold open would have been if the Fed raised 75 basis points.
It would have been different.
I might have accepted a 75-point raise to hear your cold open on that.
Oh my God, it would have been different. It's not exciting, 50 basis points. Although the market's taken it on the chin a little bit. I think the world expected this. We also had some CPI data come out. Is that right? I think we had some. Oh, I'm sorry, retail sales. It was retail sales that came out that weren't exactly stellar. So that kind of rolled over the market a little bit. Are you guys seeing anything in your sphere that is of interest with all this stuff?
Go ahead, Mark.
Are you guys there?
Speaking about the CPI, I wanted to get Jason's take on some of that market movement on Tuesday, right? Because I think going into CPI number, you of course have been talking about the 4,000, magnet and whatnot. And I think we saw some really interesting price action. Like on the announcement, we got that, 7.1 print. Everyone's just like, SPOOs were up 140 points, I think at one point, but then we trickled right back down, right?
Mm-hmm. Yeah. So Volland was showing basically, it's been interesting in SPX recently because there have just been kind of these strikes that have been whales, and as opposed to kind of an even distribution that we had during the bull market. And so what ends up happening is these strikes become strong resistance or support, or they become Vanna magnets. And so Vanna, as you guys know, is a delta movement as it relates to implied volatility. And when you go at the money, implied volatility movement doesn't have much impact on the delta. If you have a delta 50 and implied volatility goes up, it's still the same chance of being higher or lower than that strike. But calls tend to be negative when they are below, not calls, long options tend to be, their deltas go down if they are above the money or below the money. So, and vice versa. So they go up when you're above the money. And so that's kind of the, sorry, I flipped that, didn't I?
You flipped it. Deltas go.
Yeah. So because of that flip, it creates a magnet effect when, as long as implied volatility is working kind of similarly as it should, which is implied volatility goes up as price goes down, and implied volatility goes down as price goes up. It could create a magnet effect on long options in particular. So I saw a very strong negative Vanna at 4,100, which would be repulsive because as price goes up, implied volatility comes down. Implied volatility comes down, deltas go up, which means selling. So it pushes back on that 4,100. Mm-hmm. And that's where we got to with CPI. We got up to that 4,100 area, could not go over the hump. And then a positive Vanna at 4,000 brought it right back down.
Okay.
So as event vol happens and event vol comes down all the time after the event, you can kind of predict using these Vanna strikes what's going to happen.
That's nice. So your levels are 4,100. Is there anything beyond that if it busts through there or not yet?
It would go to 4,300, but this is only good for this week because this is option expiration week, and that's where those strikes are.
Okay.
So
yeah, right. So this is a serial.
So, after this week, there's going to be a completely different outlook. All of a sudden, 4,100 doesn't mean anything.
Okay, got it. Okay, good. Mark, you had some questions about that one of your viewers posed to you about market making, which is kind of up our alley a good bit. I've been doing some talks around the country on market maker hedging and that sort of thing, so it's kind of pertinent, I suppose. You want to tee those up?
Yeah, for sure. I thought these were really good questions, so definitely shout out here. And so the first one was, say you walk into the floor on Monday morning and someone is bidding on 100 lot of the Netflix 500 call with zero open interest. How do you price this? And I think it's probably based off, a lot of our discussions about how important open interest is in terms of like evaluating and pricing and all that. So Lex, back in the day, broker walks in, Netflix 500 call. Netflix is trading like 370 right now.
Right.
What goes through your mind? What are you thinking? How are you pricing that?
Yeah, so where we probably did it, before it really got sophisticated with computers, is we looked at similar options. And there's term structure to look at, and there's also intra expiration or intra month sort of skew. So this is a well out of the money option, I think, according to the example, right? So if this is a new option in a chain of options, we can use similar volatilities around that strike. That's the easy one, right? And once we always had implied volatility as our biggest important component, because interest rates were definitely findable, meaning that you just look and see what treasuries are being charged and use that interest rates. That wasn't really tricky. Base expiration is defined, strike is defined, right? Dividends defined. I mean, for the most part. And then you got to get this very nebulous implied volatility number. Well, if you have like strikes around it, you can kind of place it in the curve. So if there's a 34 vol down below and a 33 above, it's going to fit somewhere nicely in there. You kind of put a market out there and you wait for open interest to come your way. So if they start banging the heck out of that bid that you put out there, guess what you do? You lower the bid, which is also going to lower the offer a little bit. And then now you have a new implied volatility that's assessed from that new market, right? So that's how we did it in the very early days. If it's a brand new option, again, we had models that we would check to see what's expected in implied volatility and run it that way. How did you guys like to do it?
Yeah, very similar, right? Like, even if you can't interpolate between two strikes, you had some parameterized vol function that would say what vol looks like on the 500 strike if, even if 450 was your previous top or whatnot. So definitely lean a lot on the models in between the different months. I think with regards to the specific open interest component of this, I'd say that Netflix is probably a little different than, say, ticker DCF that's pharmaceutical company that has 200 open interest in total, right?
Yep.
Netflix 100 lot doesn't really scare me that much. If someone's trying to trade a 10,000 lot on a newly listed strike or in like a flex trade on a different month, or a different expiration, that's going to start to smell a little bit fishy, of course.
Right.
100 lot in Netflix, definitely you can lean on a lot of the other liquidity in the product to kind of hedge yourself out. To the extent that this is the only open interest or that it's a predominant, percentage of the existing open interest, that's where you're not going to be able to get those other options positions on to have kind of a balanced hedge, right? Ultimately, you don't want to sell 56 vol because you think 56 is, a couple clicks over where it should be trading. That's not the bet you're making. You're making the bet on being able to trade out of this for positive edge in a couple other places.
Yep.
I have a question.
Yes, Jason, go, please.
So if you are the only maker in an option class and you just start seeing bids coming in on this, do you play the bids? Do you sit there and see if they will scale, see how far they can go before you would before you take the trade?
I would say like opening new listings is like always one of those sort of scary things, right? There's a brand new product, it's coming out, whether it just IPO'd or whether it, just met some of the other criteria to get listed options on it. It's probably getting listed because some customer out there wants to trade it. And so particularly if this has been a name that's been around for a little bit and just doesn't have options, usually that means someone's interested in trying to trade it. So you have to be particularly nimble there. And I think that's the name of the game, right? You're putting up 1 lots if they'll let you, 10 lots if that's the min size, and you're given wide markets. You have a wide kind of like your market is just your confidence interval around your theoretical value, and your size is your confidence in that band. So you're small on the size and you're wide on the market, and you just move those levers until you start seeing two-way trading.
Yeah.
And hope that the first 10 lot you bought or sold isn't going to, cost you your month.
Yeah, we, as DPMs too, we were DPMs in a lot of stocks. So we had to set the market from the beginning, right? And we had Google was one of our big listings, and Google never traded options until we got it. So we had no idea, what Google implied volatility should necessarily be, right? Because the stock, was just newly listed and all that kind of stuff. So we had to go back and look at similar stocks to what Google may represent, come up with some implied, and do exactly what Mark said. So we're out there trying to be as nimble and lean as possible, not trying to take much inventory, and just more or less doing the dance at first until we find buyers and sellers around a value, right? And that was the hardest part, I think, was figuring that out. You just don't want to get stuck with inventory at really bad prices. So you're just schlocked from the beginning. That's where it gets tough. But I think we always did a pretty good job, the market making community of getting it fairly right. There's mistakes, right? But it wasn't monumental, I don't think. So.
For sure. That's actually a great segue into the second question. And that was specifically about how do you come up with that volatility estimate? Especially on something new, right? Google probably wasn't paying a dividend then. Actually, I don't know if they are now even. But you knew a lot of the characteristics, but that vol number on something totally new, you're looking at historicals, or you're looking at peer companies, where are you getting that implied vol number that you're plugging in?
That's what we did. We definitely looked at peer companies. We looked at historicals. That was something that was computable. If the only problem there is if the stock is newly listed and it's going to, it IPO'd. I think there's a holding period before it can have options listed on it, if I'm not mistaken.
It's only 5 days though.
Oh yeah, so now it's fast. So then they throw you in with the lions. And I guarantee you that the Goldmans of the world, they have customer interest right away. And all of a sudden it's going to be ready to roll. You have to be on it. We would use historical vol if we could of a like product, and get a feel for intraday movement. So those ATRs that people like to talk about, we try to get a flavor for what that could be. And we try to price it across intraday moves and then close to close kind of activity too, which can be different things, right? You can have stocks that close unchanged every day but move wildly during the day, which we had that kind of stuff. So that had to be accounted for in your implied volatility estimation. So we had to really kind of work to do that. It was a lot of this. Let's see. I hope this works and let's not get run over, right?
Exactly. And the thing I'm impressed about is how quickly some of these popular listings find their sort of equilibrium. That pharmaceutical stock I mentioned, that's going to take days, weeks, months for that to price out. But yeah. I remember when the Facebook listing came out and we were excited. That wasn't the type of name that was traditionally in our wheelhouse. We knew it was eventually going to get to be one of those top volume names, and wasn't exactly our bread and butter. But we thought, hey, it's going to be a couple days when this, is interesting. Matter of minutes to hours before those markets were rock tight and thick and deep, and and Facebook listed 6 years ago. So
right.
It's the equilibrium is found very quickly.
It is
with customer interest, professional interest, all the above.
Right. No, that's good. What is you have another question, right?
I do have a third question. And so this one is, based on your market making days, what characteristic of order flow would hint to you that a particular put purchase or call purchase, right? It doesn't, is outright bearish versus a hedge, or outright bullish. So what's going to give you an indication that this flow is directional or toxic, as opposed to, just hedging type flow?
Yeah, that's an interesting one for me. I would say based on how we behaved, we didn't care.
Yeah.
Yeah, so we wouldn't make a judgment on direction necessarily. At least thinking back, I don't think we did. We would hedge the delta and assess the effect it had on our inventory. Whether we had more put units that we were short all of a sudden or not, or call units that we could be short, and then we'd go about our business of rolling the stock delta hedge out of the parking spot into some other option to defease some of the risk that trade could have given us. And then once we get it more or less hedged with all that mechanics of moving around deltas, we'd be like, okay, let's play again. Let's do it again. We wouldn't even say, oh, this is so bearish, we're going to lean short. I don't know how you guys were, Mark, but we were very non-directional.
For sure. No, I definitely agree. And I think the thing that we would mostly try to suss out from order flow is not necessarily whether it's directional or whatnot, but whether it was toxic. So whether this person knew something about the inputs that was causing your input to be mispriced. If I'm saying that vol and SPX right now is 22 or 24, it's a pretty liquid curve. You can say that downside put should be worth about that. And you sell that and you sell your deltas against it, like you're kind of moving on. If someone's buying puts from you because they're speculating on the dividend changing, or they're buying puts because they think you've wildly mispriced like a future expectation of something, that's the kind of flow that you were more trying to suss out. So I didn't care if they were hedging or if they were betting on stock going down. You tried to care about, does this person know something that I don't know? Maybe they read the stock feed faster, that your stock clock is, or your stock feed is, half a microsecond faster than theirs, and they know stock's going down, right? Like you get picked off on all kinds of different levels of toxicity. But fundamentally, the question was, what am I mispricing because of this? Yeah,
no, that's a good point. I think I told a story at one of the summits I was at over these past weeks about one of our worst trades or trading episodes, and it was as a DPM, we kept getting dinged on selling the put, buying the call, and we were always able to get our stock hedge off, which would mean we'd have to sell stock. So we get into this spread that we market makers would call a reversal. So it's just and it was always on the same strike. It was literally a reversal. They were handing it to us in a way that we could leg it and allegedly make money on it. Well, long about the 1,000th contract that we did, thinking we're getting all this edge, we said, wait a minute, they don't pay a dividend, this company. There's something going on here with the dividend. And it was one of those, this looks too good to be true, because they were giving us so much edge on it, dollars. I'm like, this isn't good. So that order flow, as Mark's point, was ultimately toxic, and we should have known better, well along the way. I mean, there's no big institution that's going to give you that much edge without there's some other information that's not part of the full equation. So we end up losing a bunch of money as a result, and learned a valuable lesson because it was toxic order flow. So I think you're right, Mark. I think we would always assess, was it toxic or not was it bearish or bullish is probably how we would do it. Any of this makes sense, Jason?
Oh yeah, I would think that would be the hardest thing, but you can't. How do you determine that? I mean, other than who the person placing it is. I mean, unless you get a rhythm, something like that, then or something that's so outsized. I mean, outsizing, I think, would be a big one, like a big whale. Some pharmaceutical that otherwise has one drug, and all of a sudden there's a 10,000 lot on a put out of nowhere, and next thing you know, that drug is recalled or something. I mean, that kind of stuff is that would be very scary to me as a market maker.
Yeah, and that's all part of your risk analysis. And I know Mark probably dealt with risk managers. We had them. They would assess what your big time risk was, and we look at a portfolio level, we look at individual stock level, all the way along the board. And if you got outside of what we thought was parameters, you'd get the proverbial tap on the shoulder and be asked to fix it. So that's kind of how we dealt with things as well. But you get caught. You sometimes being in the market making community, you don't have choices. You can't. If you're a DPM, you can't leave. You can't go on lunch break. There's no Starbucks run. Your firm is always represented in the pit. So didn't have a choice on a lot of that.
The thing that's hard, though, is that you play so many head games with yourself, because you see that pharmaceutical name and you're like, wow, this guy's got size. He's doing, there's no open interest and he's doing 5,000 contracts. He might just be some gambling degenerate with a bunch of loot, right? And like half the time, that's what happens, right? Like that these, big swinging, funds or whatnot don't know any more than anyone else. They're just taking a shot. And so, sometimes you want to be on the other side of that, and it's not scary. Like a lot of the characteristics of what you think would be scary aren't necessarily marks of sophistication. So you end up in this like second guessing. And so I think that's where like systems and just like you said, a little bit of risk management, because sometimes you do want the other side of that trade.
Right. Yeah, no, I that's right. These are all good questions. I see we're getting a little late here, so let's shut her down now. What I wanted to talk about was synthetics and how market makers look at positions. So let's push that off for the next one, which hopefully is next week, next Thursday, and we'll publish this episode based on those questions. But I do want to get around to synthetics because I did get a lot of questions about it. And just to tee it up for next time, people have been asking, when you do a butterfly, it's a combination of a couple spreads. If you think about it, right? It's a call, let's say a call butterfly. So it's a call bull spread and a call bear spread tied into one. And when you break these things apart, you start seeing the relationships. And I was talking about synthetics in relation to these reversals and conversions. And I got a lot of questions about that. And they didn't understand it at first until we explained it and said, oh, I said, yeah, you have to have these pricings always together. Otherwise, there's an arbitrage that someone is going to take on you and put it back in line. So these have to exist, these relationships, boxes, all these spreads, all that kind of stuff. There's always a relationship. And it's very much a banking mathematical relationship. Otherwise, there's an arb. So we'll get into the details of that next time if that's good with you guys.
Yeah.
Cool.
I like it.
All right, guys. Well, that was awesome. Thanks for coming, Mark. As always, Mr. Wine Country overseas. I love it. Jason, you're not on another vacation. That's amazing. And me, I'm traveling again. Go Shocker. So you guys have a good rest of the week and stick around and we'll close her down. All right.
All right. Later, Lex.
Happy trading, everyone.